Hello, this is Rex Crandell, CPA attorney in Walnut Creek. Today we'll be talking about dissolving your California corporation. When a corporation liquidates, one of the first things it does is the board of directors pass a resolution stating the company is going to be liquidated, all the assets are going to be distributed, and all the liabilities paid. The resolution from the shareholders or the directors first make the resolution, the shareholders ratify it in writing, and then after that point you should be preparing an IRS form 966, which alerts the IRS that you are going to be liquidating. And it's important to do this because you would normally elect on that form 966 line 3 that you're electing a 331 type of liquidation, and there's very important reasons for that. When a corporation liquidates, it's treated as the assets were sold to the shareholders. It's just not a distribution. So you have to determine the fair market value of all the assets being transferred out, and you're not permitted to use the book value that you would take from your depreciation schedule. But you have to file this form 966 within 30 days of the election to dissolve the corporation. I would also include it again when you file the 1120 form, IRS form 1120, with the corporate income tax return. So that's from the corporate side. There's going to be a gain or loss if there's assets have gone up in value when they're distributed, and it would have to be reported on the corporate return. When the assets come to the shareholder has a basis in the stock, which is usually what they invested in the corporation, plus additional contributions of capital. And the value of the assets that they get back on the liquidation, if there's a difference, a fair market value is higher than their basis in the stock, the individual's basis, then the individual has to report a gain on that transaction, and this is double taxation. We tax the corporation, we tax the individual a little bit differently, but it is double taxation. If you have to look at each asset. Sometimes you might have to have them appraised to get what the value is, say some special equipment or certain things. It's good to get an appraisal in writing or third party. And it's really important for the shareholders to know what their basis is in the corporation as an investor, an individual, because that's going to end up being on their tax return. If the shareholder has not been keeping their basis, no one knows what their basis is, I suppose some people would end up using the corporation's basis on the corporate books, reporting this transaction. I don't think that's quite proper to use that number, because it can vary from the shareholder's actual basis. It's called outside basis to the shareholder, it's just the term, and inside basis from the balance sheet, from the corporate side. If someone owns the shares and somebody recently passed away, husband or wife, and they get a stepped up basis because of inheritance tax or because of it was community property, then the fair market value on the spouse's date of death would be used as the shareholder's basis. The individuals are going to need to show the gain on the Schedule D, gain or loss on the sale of securities, and it is treated as a sale. In addition, you might end up needing to file the Form 8949 to accompany your sale disclosure on Schedule D of the 1040, and the gain would be taxed. Now, if you qualify as a small business corporation under Internal Revenue Code Section 1202, which is small, closely held corporations, for more than 5 years, you have to look at the exact detailed criteria. If you qualify under that for the small corporation liquidation, any capital gain that you have would be cut in half because of that exclusion from the 1202 stock. After all the assets have been liquidated from the corporation, you also need to file a dissolution with the state of California to dissolve the corporation. And if not, it's going to create a situation where every year you're going to have an $800 annual franchise tax fee minimum. You can go up from there if your sales are above $250,000. So after all the assets are liquidated, dissolve the corporation with the state of California, and then you would file your final corporate return on the 1120 for the federal, and then the Form 100 for the California, checking the box that said it's the final return. We've been talking about C corporation, and if your liquidation happens to be an S corporation, the liquidation is a little bit different because of the flow-through method that you know on the Form K1, but essentially it's the same process. So I hope this has given you some insight. There's a lot more to it. However, this is information summarized so that you'll be able to get started in a corporate liquidation. So if you have any questions, you can contact our office in Walnut Creek at phone number 800-464-6595. And thank you for watching.